Good day, everyone. My name is Atingosi, and I'll be taking you through our latest EIA report on Tesla. Just kicking it off with the executive summary. I think the overall theme for this report is that Tesla is a highly innovative company, which we think is very appreciated by the market, which is reflected in its valuation. Key points from the presentation and the report: strong results which came in ahead of expectations, pretty much driven by strong automobile volumes, fundamentals improving in this period, with margins expanding and cash conversion strong. Their outlook was reinstated, so they're looking at expanding volumes to roughly 50% on average on an annual basis, and they achieved that in this quarter. We value the company on a price-to-earnings ratio, exit PE of 30 times, which has an intrinsic value of 548, which implies about a 19% downside. I mean, we think given the share price, a lot of expectations are already priced in the company. And when you look at FactSet consensus as well, it's even higher expectations, which poses a risk. Our recommendation for the company is a sell. Looking at the event that took place, which is the first quarter results 2022, revenue was up 81%, mainly driven by volumes, which were up about 67% in the period. Operating profit improved to 3.6 billion versus roughly $500 million in the same period last year. So the margins expanded in this period to 19.2% versus 5.7%. Net income improved to 3.3 billion versus roughly about $500 million in the same period last year. They also benefit for the lower effective tax rate that they have and low debt services. Free cash flow was quite strong, which they use that to pay down debt in this period, which is significantly low, and they sit in a net cash balance. Just unpacking the divisions, results, as mentioned, were ahead of expectations and quite strong. And the main driver behind the results was the volumes being up 68%, which resulted into automotive sales being up close to roughly 90%. With automotive sales being high, they also got higher regulatory credits, which are up 31% in this period. Automotive leasing quite strong. And really the one area which they came in slightly below consensus was the energy generation, which I cited adverse micro environment. The services and other businesses quite strong in this period, which is mainly them expanding in other states, their insurance offering. So when we value Tesla, it's a little bit complicated, given that it's a first mover advantage. Its IP is highly differentiated, and so its business model. So we look at it at a peer group basis, and when we consider our peer group, we consider luxury and high growth automakers, such as luxury sites such as BMW and Mercedes, and also other high growth automakers. Electric vehicles, as we mentioned, Tesla sort of had a first mover advantage in the space, and consensus only looks at 2023, the first guys to start making a profit within that space. Look at disruptive companies such as Google and Apple, and clean tech companies as well. And so we put it all into a scale, and we try to imply a multiple given the growth rate. So we take a view on volume growth and sort of lean towards consensus around the margin spot, and our estimation around earnings growing around about roughly 24-25%, and our implied multiple is about 30 times. Consensus is looking at the company growing slightly above 33%, and given the share price, the implied multiple is about 40 times. So you sort of gauge that market is implying that the company should be trading at a higher multiple. And when you look at FactSet consensus, its applied multiple, it's around about 60 times, given the target price of about $1,000. I think roughly the share price is around $700 per share. So you can sort of gauge the high expectation that the market is implying. I mean, that means the company would probably have to grow around about 60-70% in terms of volume growth, which we think that's very, very ambitious. I mean, we do try to consider for the fact that Tesla is very innovative in our multiple, given the peer group, and we also give it a slightly higher benefit on the bull case scenario as well. But regardless, we still think that the expectations being priced into the company is very high, and that poses a risk in itself. So we look at our bear, base, and bull case scenarios. So the bear case sort of leans towards margins moving towards this, luxury high growth multiples are growing about 7%. Our base case looks at about 20%, which we take a view on the volume growth. And our bull case is slightly where consensus is. So looking at our valuation model, it sort of gives us this price to earnings, which really is vary from 22 times on the bear case and around about 45 times on the bull case. And then this is the implied intrinsic value. And when we look at our probability weighted scenarios, on our bear case, we have about 50% probability, and our bear case is slightly lower than the bull case given the disruptive nature of a Tesla. So the implied intrinsic value is about $548 per share, with a downside of roughly about 19%, which is why we have a recommendation of around a sell. I think the symmetry around the valuations is negative. I mean, if we probably leave with 5 key points to conclude our presentation, I think the company is very, very innovative, which is highly appreciated by the market, which is, as we made our case in the high expectations priced in, the results are strong and ahead of expectations. And the risk we see around the company is competition coming in, execution in terms of the new products they're looking to roll out and support that volume growth. And really, it's hard to find distinct peer groups, so it poses a risk in itself. We value the company on a price to earnings about 30 times with an intrinsic value of 548, and the recommendations is sell. So that concludes our presentation for today. And if you wish to place a trade, you can talk to our traders. And please take note of the following disclaimer. Thank you.